Losing your home is often one of the biggest fears people have when considering bankruptcy. It is a natural concern, wondering if you can continue to meet your obligations and keep the roof over your head throughout such a challenging financial process. Many individuals worry that filing for bankruptcy automatically means surrendering their most valuable asset. The good news is that in most cases, yes, you absolutely can continue to make your mortgage payments after filing for bankruptcy. This is a common and often necessary step if you wish to keep your home and protect your long-term housing stability. It is important to understand the specific rules that apply to secured debts like your mortgage. When you file for bankruptcy, an immediate legal protection called the automatic stay goes into effect. This temporarily stops most creditors, including your mortgage lender, from taking collection actions against you, such as foreclosure proceedings. However, this stay does not eliminate your mortgage debt itself. It simply pauses the process for a period. Your mortgage is considered a secured debt, meaning it is tied to an asset, your home, which serves as collateral. Because of this, it is treated differently than unsecured debts like credit cards or medical bills, which typically have no collateral attached. How you proceed depends largely on the type of bankruptcy you file, primarily Chapter 7 or Chapter 13, and your intentions for the property. If you file for Chapter 7 bankruptcy, you typically have two main options regarding your mortgage. You can choose to reaffirm the debt, which means you agree to remain as personally liable for the mortgage even after the bankruptcy discharge. If you reaffirm, you must continue to make your regular monthly payments on time, exactly as you did before bankruptcy, to retain ownership. The other option is to surrender the property, meaning you willingly give the home back to the lender, and the underlying debt is then discharged, freeing you from that specific obligation. For Chapter 13 bankruptcy, your mortgage payments, including any past due amounts or arrears, are usually incorporated into your court-approved repayment plan. This structured plan allows you to catch up on those arrears over a period of 3 to 5 years, while simultaneously making your regular, ongoing mortgage payments. This path is particularly helpful for those who have fallen behind. In both Chapter 7 and Chapter 13 scenarios, maintaining consistent, on-time payments is paramount to keeping your home and avoiding foreclosure actions by the lender. The automatic stay provides a crucial breathing period at the beginning of your bankruptcy case, but it is not a permanent solution for secured debts like mortgages. For those pursuing Chapter 7, a reaffirmation agreement is a formal legal document signed by you and the lender, and then it must be approved by the bankruptcy court. This agreement essentially reinstates your personal liability for the mortgage, allowing you to keep making payments and retain legal ownership. It also ensures that the lender will report your payments to credit bureaus, which can help in rebuilding your credit post-bankruptcy. Without reaffirmation, even if you continue paying, you lose personal liability for the debt, which can be both a benefit and a drawback depending on your future plans. In Chapter 13, the structured payment plan gives you a clear and legally binding path to curing any defaults and continuing your homeownership journey under specific court supervision, offering a solid framework for financial recovery. Navigating bankruptcy while trying to keep your home requires careful consideration and proactive steps. By understanding your specific options under either Chapter 7 or Chapter 13, diligently making your required payments, and working closely with an experienced bankruptcy attorney, you significantly increase your chances of successfully retaining your property. The overarching goal is to demonstrate your unwavering commitment and financial ability to fulfill your mortgage obligations, ensuring your home remains a stable and secure part of your financial future as you move forward.